It is a common fear that you're going to run out of money in retirement, and with rising prices and the risk seems much more real. Matt Landon, certified financial planner and CEO at Semmax Financial Group, is with us to talk about it. So what does risk management look like once someone actually stops working?
Yeah, so there's a couple things. One of the big ones is that ability to make that money back. So when we talk about risk, one of the things you talk about is market returns, and obviously that's a key component. But another one is health concerns. You know, what if something happens to either you or your spouse? Do we have a nest egg set aside for that? What about changes with tax rates and tax codes and where we're pulling from these different accounts? So there's a lot of different risks you want to keep in mind beyond just the stock market, but that is a big one.
All right, and I'm thinking to myself, we already are thinking about a million and one things. That is definitely above our pay grade, right, when we're just the retirement person. So let's talk about what makes it so different once you're actually in retirement versus just planning for retirement.
Absolutely. So one of the big things you want to keep in mind is it's called sequence of risk or sequence of returns risk. Now that sounds complicated. It's really not. Basically what it means is a large decline in your portfolio in 1 year early on can have a disproportionate effect on your returns. So if on average I make 5%, but the first year is down 20, and the next year it makes it back 25, well, when it was down that 20%, you're taking money out whether the market's up or whether the market's down. So one of the things you want to do is build different buckets. Are you pulling from a more conservative bucket and allowing your other funds to be more aggressive? So that way those market volatility, that ups and downs that the market experiences, are you not weighing on that as heavily from your portfolio?
Okay, so you told us that we should be pulling from different buckets, but
Right.
what does that actually mean? Like, what,
So-
what are the buckets?
Yeah, so there's two ways to looking at it. One way is, what is the taxability of these funds? Obviously, you have some money that's going to be IRA money. Some money is going to be Roth money. Well, that means taxable versus tax-free. And then there's also some tax money. This is things like a trust account or a joint account or money in your savings account. You've already paid taxes on that, right? So you want to think about those sides of things and say, okay, where's the right place to pull from those different buckets of money from a tax perspective? But there's also your aggressive money, your more conservative money, your more moderate money. You don't want everything lumped into one area. So if I talk to someone and everything they have is tied up in an IRA account and it's all invested the same way, that's maybe something you want to consider diversifying and having a little bit more variety in your plan so that way you're not overly exposed.
All right, we used to just take money out of one account to pay a bill here and there. You can't do that when you're retired and you're dealing with this kind of money.
Well,
that's clear.
You can, but you want to know which account should I be pulling from.
Right.
There's a number of them, and you just want to think through the different options.
Not just the plain old checking or savings account. All right, so Matt Landon, we appreciate your time and your expertise. We're going to post this entire conversation on our website under the tab called To Finance Your Future. We'll be right back.